Everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Steeper curves ahead. Following that softer than expected July jobs report, the money and bond markets have fully embraced the narrative that a Fed rate cut will be coming at the September FOMC meeting. And on top of that, additional rate cuts are also being priced in, not just for the rest of this year, but for 2026 as well. And as far as the market is concerned, it's now not a question of if, but when the Fed cut rates again. Remember, they've already begun this rate cutting process. It's not as if they're, going to begin. It's kind of restarting. And it's against this potential monetary policy backdrop. I've been asked a lot of questions about my thoughts on the Treasury yield curve and where it may be headed in the months ahead. But before we get there, it's important to point out that there are a variety of different yield curves you can follow. In bond land, however, the two curves which tend to be the most widely scrutinized are the Treasury 3-month T-bill and 10-year note curve and the Treasury 2-year 10-year note curves. And since the Treasury 3-month bill yield essentially trades on top of Fed funds for the most part, you could probably use that 3-month 10-year construct as a proxy for that differential between overnight money and the 10-year Treasury. But as we're talking to you here today, both of these yield curves are no longer inverted, but they still remain historically flat at around 9 basis points and 56 basis points, respectively. What's interesting is that the 3-month 10-year curve has actually flattened year to date and at times went back into inverted or negative territory, while the 2-year 10-year curve is steepened by about a quarter point, about 25 basis points. And this is a function of not only changing market expectations for Fed rate cuts, but more importantly, due to the fact that policymakers haven't actually lowered rates yet this year. Remember, the 3-month T-bill is directly correlated to the actual Fed funds rate, while the Treasury 2-year yield is also going to be impacted by market expectations for where Fed funds may be going in the months ahead. And what we've seen going back over the last 35 years is that, typically speaking, during each Fed rate cut cycle, at one point or another, these two Treasury yield curves have steepened. And after looking at that, it shouldn't come as any surprise. It really is just math, right? If you think about it, a declining Fed funds rate from the Fed cutting rates pushes ultra short and short-term Treasury yields lower than what transpires at the back end of the curve, namely the 10-year Treasury note. In fact, you can even have what is known as a bull steepener, and that's where both short and long-term yields fall, but the decline at the front end of the curve is more than what transpires in longer-dated maturities. So I think the bottom line here, in my opinion, the expected resumption of the current rate cut cycle should follow historical trends, resulting in steeper yield curves for both the 3-month 10-year and 2-year 10-year constructs. And for this go-around, our base case is for the U.S. economy to avoid an outright recession, but it's only going to produce slow growth. And inflation is expected to remain above the Fed's preferred 2% target. And in this scenario, short-term rates will move lower right along with Fed funds, but the 10-year Treasury yield could be trapped in this 4 to say 4.75 trading range, but nonetheless, the curve will steepen in this environment. So I'm going to end it there. I hope everybody has a great rest of the week and be well.